The other issue that I'd throw into the middle is that the resource sector inclines towards, over time, what some authors call the logic of gigantism, the logic of very, very large companies. And we see that in the Australian mineral sector, and we see it around the world. Over time, there is a tendency for resource companies to get bigger and bigger by absorbing each other and developing or putting options on all resource bodies that are out there. And there are a number of very clear reasons for this. Firstly, resource companies have a real need for economies of infrastructure and investment. Secondly, they need profitable places to invest their profits, and often they invest back into the sectors that they know best. Thirdly, they need to spread risk by diversifying into ranges of different commodities. They have a need to establish and maintain pricing power. And finally is the argument for defensive offence. Arguably, the really big conglomerations that happened in the 1990s, the BHP Billitons, the Rio Tintos, occurred out of a logic of gobble up others or you will be gobbled up. And there was a real logic to that. So this is a market sector of giants. Of course, there are the smaller players as well, but over time, arguably, it's an industry in which the giants predominate. Now, I'm coming to the end, but I'd like to just throw into the middle of this one of the biggest step changes that has occurred in the 20th century, and certainly the 21st century, and that is the entry of China into resource markets. I'm going to go very quickly through this because a lot of this story is already familiar to you. China, of course, in China we've seen something occur that's quite extraordinary. A large and hitherto self-sufficient producer and exporter of mineral resources. China has some of the largest holdings of certain mineral resources in the world, into one of the world's largest consumers and importers of mineral resources. And it's all occurred over the space of 17 years. 1993 is a key year because in that year, China became a net importer of oil. Throughout the 1970s and 1980s, China had a reputation as one of the largest exporters of oil and one of the largest swing factors in oil. All of a sudden that changed. And it was because pure demand was outstripping supply in China. But something else was happening in China as well, and it related to the rest of China's mineral sector. And that was that as the post-Deng Xiaoping market reforms occurred in China, it released a market logic in China. And what the market logic showed was that if Chinese firms and Chinese steel mills were suddenly following the logic of the market, then they could get much better minerals and much cheaper minerals overseas than they could in China. Because of the inefficiencies, because of the waste, because of the different quality of Chinese minerals, suddenly China realised that it was much more economic to go out and get resources. But China entered a particularly sagging global minerals market. There had been decades of sagging demand in the global minerals market. The resource sector, remember in the 1970s, 1980s and even the 1990s, was seen as a sector in the doldrums. It was competing for investment against IT and other sexy economic sectors, and there had been oversupply for many years, and the price of most minerals was falling. Now, Chinese demand dried up excess supply within the space of about 2.5 years. It moved prices that quickly, and it happened. We went from resource surplus to resource deficit in the world around the years 2002, 2003. What happened in the 2 or 3 years after that was that most companies and most markets misread the scale and sustainability of Chinese demand. Remember, in the 1990s, most people thought that the Chinese boom couldn't be sustained and the Chinese boom would come to an end. Well, it didn't, and suddenly the resource sector was caught by surprise, and it was caught with severe undercapacity to produce the sort of volumes of minerals that China was importing. What it allowed, as I said earlier, was it allowed smaller, more risk-acceptant players into non-traditional geographies at higher cost. And of course, China was paying through the nose for decades of sectoral disinvestment and the eventual reinvigoration of the mineral sector. China obviously got frustrated at being the biggest consumer, the biggest driver of price changes, but it was very much a seller's market. The interesting thing about the last 15 years is that China has decisively moved the global terms of trade against itself, against its own interests. It's driven up the cost of the minerals it needs to import and driven down the cost of the manufactures that it exports. So China was and is spooked by inflation, and its response was to try and invest in upstream projects. Generally, Chinese companies and most Chinese investment overseas is in resources, and generally that investment wants direct ownership, operational control and offtake rights for assets that are operating now and producing now. However, China is finding that the high-quality Tier 1 minerals assets are already sewn up by the majors, and therefore it's going for marginal investments around the world. And of course, the likelihood that some of these investments are not particularly wise investments is very high. So the scale and nature of Chinese investment in countries like Canada, Australia, and parts of South America and also Africa is causing alarm. And unfortunately, the alarm that it's causing in places like this country and others is only feeds back into the paranoia the Chinese feel about being locked out of the global minerals industry. So I'm running very quickly out of time. Over the next 20 years, the current resource supercycle is likely to continue. To quote just a couple of figures, up to the years 2025, China's energy usage will likely increase by 156%, and its steel production and iron ore consumption will likely quadruple in that time. Resources and our dependence on the current resources will likely remain similar or even greater to that we exhibit today. And finally, there is little prospect of resources depletion or significant resources depletion over the next 20 years. So I personally place very little store in the peak oil or peak minerals predictors over time. So, what does the international relations of resources look like? It's useful to compare the international relations of resources to the international relations of, say, military power or economic power. And I think there are some real differences between the international relations of resources and the international relations of these other types of power. Firstly, power is much more divided in the resource world between producers and consumers. Both producers and consumers do have power, but it's power that they wield against each other. Production power and consumption power are more fixed. We can tell now, pretty much, who the big producers of the major resources will be over the next 20 or even 50 years, and we know pretty much with a great deal of certainty which will be the major consumers of resources. probably the key difference is that whereas military power can be dormant, it can exist even when it's not used, and economic power can exist when it's not used, resources power can't be. Resources power is only powerful when it's activated. Resources sitting in the ground give you no power whatsoever. But once you start digging them out of the ground and selling them, you start to accrue some power. But, and here's the rub, once you start producing and exporting or consuming large amounts of minerals, the influence that you have as a consumer or as a producer is offset by some pretty serious dependence and some pretty serious vulnerabilities to risk. Consumers and producers' power is offset by their dependence on each other. Once you start producing minerals, in order to be able to continue to economically do it and to acquire power for it, you need people to keep buying the minerals that you're producing. You need demand security. Similarly, once you start consuming minerals in large amounts, you need supply security. You need people to continue selling you good quality minerals at proper prices, at reasonable prices. So you lock in, as resource producers, as resource consumers, long-term dependence on each other. And you lock in large-scale dependence on other sectors of the economy. The fifth aspect, I would say, of the international relations of resources is the pervasive struggle between the state and the market. There is something very interesting that's going on in the resource sector currently, and it's the fact that most of the resource sector is market-based globally, but states generally don't trust markets. Most states don't trust markets. In 1970, nearly 70% of all the non-communist world's oil production was produced by 7 major companies, the big 7 sisters, as they so call it. Today, almost 90% of all oil produced in the world is produced by state-owned oil companies. So you can see the massive step of the state into the market. And states like China don't really trust the market to continue to produce. So each needs the other, the state and the market, but neither trust the other either. And finally, there is the dynamic struggle between the established players, the rich world, the Western world that has sewn up the Tier 1 resource assets around the world, and the emerging players, the Chinas, the Indias, the Vietnams, that are resource hungry and realise that they're playing by rules other people have set, that they're playing on land that others have tied up. And that will be a fascinating struggle to watch over time. Now, where does this leave Australia in the world? Well, firstly, I'd like to pose the question, do our resources give us hard power? Do they give us the sort of power that we can use to really increase our position in the world? I think to have real hard power, a resource needs to have 4 conditions. The first one is it needs to be absolutely central to the functioning of an economy. By that I mean, if it was withdrawn from an economy, the economy would absolutely collapse. The second condition is that it needs to be non-substitutable. If it's withdrawn, there is nothing that can be fed into the economy that can substitute for that particular mineral or resource. The third one is there must be significant demand inelasticity, that if supply starts to dry up or prices go up, you will see demand continue at the same levels. And finally, the supply of that resource has to be concentrated in the hands of one or a few countries. I would argue that none of the resources Australia has and exhibits that suite of 5 conditions. Arguably, the resource that comes closest to that is oil. And quite frankly, the big oil producers, the Saudi Arabias, the Russias of the world, struggle to use that particular resource as that form of hard power. I don't think our resources give us that sort of hard power. The second question then becomes, do our resources increase our vulnerabilities? And I think there's a more nuanced answer to this question. In the sense of the specific direct invasion, is China going to invade us so that it can have our resources? I think the answer is no. We are both too important in terms of a supplier of minerals for other great powers simply to sit back and allow China to come in and take us over. And in another sense, we're not important enough. We don't have enough of all of the resources that China needs to satisfy all of its demands. So I would say the answer to that is no. But in a more diffuse sense, yes. Australia, along with Canada, South Africa and a few other countries, is a free market resource producer. It's one of the last genuinely free market resource producers in the world. And more generally, we are heavily invested in free markets for resources and other goods and services. As a highly globalised economy, we need those free markets. In that sense, if resource markets and resource consumers get spooked, or producers get spooked, and start to retreat from free markets, this would be a very bad thing for Australia. It would mean locking ourselves, if we wanted to continue to trade on our resources, into the sort of strategic trading blocks that we really don't want to be a part of, because it really does risk the values and the independence that are so dear to us. So Australia there is a risk in a systemic sense that the resource markets that we rely on could start to move against us. And finally, very quickly, in a regional sense, I think there is another vulnerability. And I refer here to the resources that are going to becoming on stream in some of our most internally fragile neighbours, East Timor and Papua New Guinea. One of the things that particularly worries me is the governance effects of very large natural resource rents on East Timor and Papua New Guinea in terms of corruption, in terms of internal political fragility as well. So we could see in Australia in 20 years with neighbours that have spiralling governance pathologies and declining need for Australia. That would be a particularly nightmarish scenario. So, in conclusion, Australia does need to take its natural resource endowments seriously and think about where they leave Australia in the world. We do have very real interests in the integrity of free markets in resources, in the socialisation of new market players such as China and India, and in eliminating the causes of pervasive distrust in these new market players and between the new and the established market players. We also need to take seriously the issue of resource rents and their effects on governance in the countries in our region. Thanks very much.